Welcome to Barchart series of webinars designed to help you educate you about a variety of market concepts. To inform you of features and tools that Barchart provides related to these concepts and to give you some trader's insight to help you make a more informed investment decision. Today's subject, average to range, the Swiss Army knife of technical analysis. Now, Wells Wilder, most believe, is the father of modern technical analysis. And in his book, New Concepts of Technical Trading Systems, Wells writes that volatility is directionally proportional to range. And that range is defined as the distance price moves per an increment of time. Hello, everyone. My name is John Rowland, and today we're going to look at one of Wells Wilder's technical tools, the average true range, and how it has evolved. And we're going to look at a few of the many applications that ATR does. But before we do that, please welcome my partner and our moderator, Barchart's project director, Gene Baker. Hello, Gene.
Hello, John. How are you?
I am in a good mood today. I'm happy, getting ready for a long holiday weekend. Are you excited for a long holiday weekend?
I am. It's going to be nice here in Chicago, so I'm looking forward to it.
Get out the hamburgers and the grill and spend a little family time, right?
A little bit of everything. That's right.
Awesome, awesome. I'm excited for get a little couple of days off as well.
Same to you. Yeah.
Okay, great. So let's get started, right, Gene?
That's right. Let's go.
Okay, great. So remember that today's session is for educational purposes only, and any decisions to buy, sell, or hold or trade a security, commodity, or any other investment involves risks and best made on the advice of a qualified financial professional, and that under no circumstances shall we be liable for any losses or damage you or anyone incurs as a result of any trading or investment activity that you or anyone else engages in based on information or material that you receive through barchart.com and or our services. Okay, so average true range. Now, Wells Wilder created this process of looking at average true range. Now, it was originally developed to manage price movement for the volatility in commodity markets. Now, Wells used this average true range, and it's a very simple concept. It calculates the average of a security's true range to determine this relationship between price and volatility. So what is true range? Well, true range can be defined as the greatest of three scenarios: the difference between the current period's high and low, or an absolute value of the difference between the prior period's close and the current period's high, or the current period's low. Now, when we talk about this absolute value, what we're really talking about is between the previous period's close and a gap. If there's a gap going into this day's range, then that will take in that consideration. What is the greatest of the three scenarios? And so this is how we can take into account for gaps from day to day. Now, this simple calculation has evolved into a multiple of other indicators and systems that have been developed through the years. ADX, Keltner bars, directional movement index, Wells is volatility system, something called stop and reverse systems, which is very similar to our own trend spotter. So all of these indicators and systems owe their origin to Wells Wilder's average true range. So what I want to do is I want to show you some of the not so familiar or common techniques. And I'm going to show you one for a day trader, one for a swing trader, and one for our position or long-term buy and hold traders. Okay. So let's start with our day traders. So I call this one the yardstick of probability. And in essence, what we're going to do is we're going to use the ATR value as a measuring stick. And that measuring stick is going to look at price movement to help us define a probable range of price on any given day. In other words, kind of a field of play for us. On top of that, we're going to look at significant pivot points as anchor points. And this is where we're going to lay down our ruler, our measuring stick of probability to help us define this playing field of probability. Okay, so there's kind of some rules here. Let me just go through the rules and then I'm going to walk you through a couple live examples. So the first rule is we're going to take the ATR and we're going to add it to a significant pivot low. Now that pivot low could have been made yesterday's trading range, or it could have occurred in the overnight session. We're going to subtract the ATR from a significant pivot high that was made in yesterday's trading range or in the overnight session, and that's going to predict a probable low for today. So these pivots that we're going to talk about, these pivot highs and pivot lows, can be both directional, but they also can be accelerations of a continuation of price, where price pauses and then accelerates again. So I want you to kind of think about in that terms, like a basketball player who's like dribbling down the court, who pauses, pivots, and then dribbles away. We're going to rely on pivots that are created during openings and closes. These are going to be a little bit more significant, especially for us equity traders, those of us who are going to be looking at stocks or indexes based on these pivots are being created in the openings and closings of our markets. Now, for futures traders, futures markets are most of them trade almost 24 hours. So we'll look at more of the overnight highs and lows or accelerations of price. But we will also look at the time of day those highs and lows are being created. Again, putting a little bit more emphasis on the ones that are being created in the openings and closes, not necessarily the openings and closes here in the US, but maybe some openings and closes in Europe or Asia. All right. So that's kind of the ground rules for our yardstick of probability. So I'm going to go to start off with the S&P ES mini futures contract. And let me go to a 6-month chart here. So the first thing I want to know is, how do I discover what the ATR value is for today so I can do this measurement process? So there's two ways we can get to ATR. So the first way is over here under our technicals and the technical analysis page. If I open that up, you can see down over here on the right side, here is our average true range. Now we give you a multiple of different periods, the 9-day, the 14-day. Now 14 was the default that Wells created it with, the 20-day, the 50-day, and the 100-day. So for day traders, somewhere between the 14 and the 9 days. So day traders, we hold positions for a lot shorter period of time, maybe 1 day at a time. So we want to be a little bit more sensitive to a smaller database, right? Or current price action. So maybe in the 9 and the 14. For swing traders, maybe we'll look at the 14 and the 20-day. For longer term investors, those of us who are like buy and hold type traders, maybe we'll look at some of these longer term average true range. Let's say the 50 would be one of the ones we could look at. Now, what we'll discover is as we look at these different time frames in terms of our ATR, we're going to see that generally between the 9, the 14, and the 20, there's not going to be a lot of significant difference. Usually it's about 1 or 2% significant difference. But what we can do is we can use this kind of as an eyeball too, is to see, is our shorter term ATR rising, telling us increased volatility, or is it falling? In other words, contracting, basis the 14 and the 9. So we can kind of do that. So in this instance here, we're looking at the S&P mini. We can see that the 9 and 14 is around 107, where the 20-day is around 105. So it's kind of telling us that over the last few days, we might be seeing an increase in volatility compared to that which is over the last 20 days. So I do want to mention something here, and I'm going to show it to you in the charts. But unlike other volatility measurements, other indicators or oscillators, this is not a predictor of a change in trend, right? It's just telling us that the ranges are getting bigger, that the probability of price movement is getting larger. That's all it is, larger or smaller, okay? So the other part we can do is we can go into a chart. And let me pull the chart up. And what I did is I just made the chart a little bit bigger, so it just makes it for a nicer presentation. So under the studies tab, we can go in there and there is average true range. Now notice that the default here is the 14 period. We give you the 14 period, but we can change this to whatever value we want. We can change it to the 9, the 20, the 50, or any other value that you want. The other option you get too is we get an average. We're going to detrend that 14 period or whatever period you choose. And this is kind of an average. This is a 20 period average of the last 14 ATRs, okay? So again, this is kind of a way to look at, is our ATR rising or falling? Again, what I said to you is this is not an indication like other oscillators or detrending averages where we could use it as a predictor of potential price movements or trend changes. All it's really just telling us is the range of price is getting wider or narrower, all right? So I've added that, and you can see the black line represents our 14 period, and the blue line is that smooth average of the 14 periods over a certain number of inputs, okay? The other thing that is really important for us for our discussion is we're going to look at the daily ATR to do that measuring stick process. But we're going to move to a lower time frame. In other words, we're going to go to a frequency time frame, let's say an hour or 15-minute or 5-minute, whatever day trading time frame you like. We're still going to use the daily ATR. So we're going to incorporate that into our process, but we have to gather it from a daily chart. In other words, here is a 6-month data. We're looking at a daily frequency, right? If I go down to a 1-month data and it changes my frequency to 60 minutes, notice that my ATR now has changed. So when I'm working in the 60-minute time frame, I'm not going to rely on this ATR. Now, I can use it for other ways in terms of risk management or price movements in terms of 60 minutes, but we're going to use the daily ATR to help us use that yardstick of probability to look at range of price for the whole day. All right, so that's important to understand. So you can see that on the daily right now, you can see that on the black, our value is 107.45. And if I went back to our technical indicators, there it is, the 14 is 107.45. Now, there's also one other nuance that you need to understand here is that ATR takes into consideration the price movement of the current day in the calculation. So if you're looking at your ATR in the mornings, what normally you're going to see is that your ATR calculation is going to be less than the ATR calculation that will be created at the end of the day. Now, this is important for us because we're going to do our analysis based on the end of the day ATR. Now, how can I do that in the morning if I haven't come to the end of the day? Well, what we're going to do is we're going to use the ATR from the end of the day yesterday, okay? And then again, as you use this, you will become very in tune to your market and you'll know your ATR or at least proximity of it. It'll be easy for us. So for instance, today, right now, our ATR is calculating 107.45. We're not at the end of the day, but if we go back to the end of the day yesterday on May 24th, if I look over here to the left, you can see that our end of the day period was 110.79 or almost 111 points. If I look at the previous days, it's 111.64. So what is it showing us is that the average true range for the last 2 days is right around 111, a little bit under, a little bit over. But it also, what we're also seeing today, all things being equal, if our range is smaller today, we are seeing a decrease in the range of this particular security. Okay, so let's go back to our E-mini, and I'm in the 6 month daily frequency, but I'm going to drop down to a lower time frame. And what I want to do now is I want to create a yardstick. In other words, I'm going to use my ATR. And so one of the easy ways to do this is I just come in here in my drawing tools and I create an array. And I'm going to create an array that is around 111. So usually what I do is I just kind of draw the array first, and then I right click on the array. And then I just kind of even out the numbers here. So let's go from like 4,200 to, not 4,220, 4,200. And I'm going to add 111 or 111 to that. And so that would give me 4311, right? Is that right? Yep, there we go. And so what now I've created is a yardstick of the 111 ATR, daily ATR. But notice that we're on a 60-minute time frame. Now, what are we going to do with this? Well, I can bring this down into my current price action. And let's kind of make this a little bigger so we can see this. And we're going to do that process that we just talked about. We're going to add it to a low that was either created in the overnight session or based on yesterday's closing or opening prices, or I'm also going to subtract it from a high. So for instance, here we are in the overnight session. Here's around midnight last night, 1 a.m. So I'm going to subtract the ATR from the high that was created in the overnight session. and I'm going to make a notation of where that low projects to. So now in my charts, all my charts that I do, I always have some horizontal lines already pre-drawn. So these aren't part of the process. In other words, they're not on your chart. You have to create a horizontal line. But I kind of always have 2 or 3 to play with in when I do this analysis. So I have this one down here. So I'm going to set that is my potential target low for today. And then here is a low, right, that was created today. Let's make this a little bit bigger. Here's a low that was created today. Now, again, we said there's a lot of significance when we can find these lows and highs that are being created during openings and closing. And this is around 7 a.m., right around the open and close, in this case, the open of the stock market. So I'm going to add that ATR. And let's see, I got a line up here. And so what I've done now is, in terms of probability, I've now made a kind of a field of play for me that I know that within a relatively high percentage, that price for today is going to stay inside of this range. Now, directionally, I don't know which way the market is going to go, but as a day trader at this point, all of my strategies, all of my ideas, all of my concepts, all of my entries, exits, targets, and stops need to be defined inside of this potential range. In other words, I'm going to look for entries somewhere in the side of this range. I'm going to look for targets inside of this range. And I'm going to make sure that when I put a trade in, that my stop, because I'm a day trader, is going to be inside of this range. Now, I don't know which way the market is going to go, but at least I have this probability of where price is. Potentially could go. All right, so let's look at over the last few days, and let's kind of like, I want to give you a couple examples here. So these red lines that you see here these are again, these yardsticks of based on the ATRs that were created for that particular day. Now let's go to this one right here. And again, remember ATR is an average of true range, and true range could be an absolute based on the previous day's close and the range of probability when we take in consideration of gaps. It's not necessarily just the range of price for that particular day. It also takes into consideration gaps ups and gaps down. So remember, this yardstick was created based on the previous day's ranges. And so if I add it, in this case, subtract it from that pivot high that was created during the closing range of the previous day, what it's doing now is predicting a potential low for tomorrow's trading range. Now, in gap theory or day trading gap theory, this would be a great trade. This is what we call an outside gap on this hourly time frame. Price gaps below the previous candle, right? That's usually a very bearish signal. Now, this happened at 5 o'clock in the evening when the market reopened. You know, maybe you might not have been trading futures contracts at then. But for instance, let's say you came on in the morning and you said, oh, price gap lower, it's trending lower. I feel like the momentum of the market for today is lower. I want to take a short opportunity. And maybe you came in right here around 8 o'clock in the morning and you took a short position. The key here is now I have to make sure that I set my risk and my target inside of this probable range, knowing that the ATR is projecting this as my potential low. I need to make sure that my target is well inside of that range, somewhere inside of it. But I can also be a little greedy. I could try to capture maybe 85 or 90% of that range, knowing that if the momentum or the trend of that intraday trend is continuing to go down, how far could it go? How far is my ATR predicting? And you can see in this example, it was a great predictor. Not only did price fall, but it literally fell within a few points of where it had predicted based on the true range. Pretty cool, right? And this is a process that you can do. It works in all markets. It works in all futures markets, and it works in equities markets. Now, it doesn't always go from one end of the extreme to the other. That is a rarity. But it does help you to manage risk and help you to set targets that are more realistic. In this case, we probably could have caught a nice little trade out of that. So the other thing that we can do in terms of doing these probability extrapolations is, for instance, here was a pivot low again. This one was created in the 4 a.m. session, which is the European opening. Again, this is the futures market. And then we added the ATR to it, and it projected a potential high. Now, what we can do is, in terms of looking for opportunities, some of you might look for what was called supply or demand or support or resistance. And this projected a high over here. And if I look over to the left, here is an area of potential resistance or a supply zone. Now, why do I like this, or why do I identify this? Well, price fell, paused, and fell away. Again, pivots don't have to be change in prices. Pivots can be where price accelerates, pauses, and accelerates again. So this could be a significant pivot and a potential entry. The other reason why I like this area is that this area was created right after the opening of the S&P market. So this has a lot more significance in terms of targeting. Now, it didn't get there that next day, but it did get there the following day. So a lot of times what you can do in these ATR extensions and extrapolations is it can enhance or add greater probability to an entry that you are going to play out, maybe not today, but maybe within the next 2 or 3 days. So you can see price return to that level, and then it fell away from it. So there's 2 variations of how we can use this, okay? So let's go to gold. And again, I'm in the 1 month, 60-minute time frame, but I still need to find out what my daily ATR is. Now, gold has been open for a while when the range is a little bit more established, and I do look at gold on a regular basis, but we can see that our 20-day ATR is around 29.5 approximately. The 14 is a little bit less. 28.8, and the 9 is around 27.8. So, somewhere between, 28 and 29. Again, what I said, it's not a lot of significant difference. But again, if I just go back to my chart, the easiest way to do that would be go to my daily time frame, look at the end of the day from the previous days. But let's just kind of use 28 and a half as our tool. So here we see prices rising, and we made a high. Now, when was this high made? Well, this high was made yesterday between 8 a.m. and 10 a.m. Again, a pivot of price change that was created during the morning session. Is that significant? Yes, it is. So what can I do? Well, I can take my ATR. Now these represents what the ATR was from the previous days. This is around 28. I think it's a little bit wider now. It's 28.5, but just work with me. And so I'm going to subtract that from that pivot high. And now what it's doing is predicting that the next movement, whatever movement is going to come, in this case, a lower price movement, that price should fall at least to the lower part of that true range. And you can see that that did happen, and that did happen, and that the peak of this price falling went right to 10 a.m. Again, ATR doesn't care about day to day. It's just a period of time, right? ATR could move in an hour, it could move in 4 hours, it could move in a 24-hour period. In this case, it moved from the opening of the previous day to the opening of the following day, but it moved one true range. So if you were in this trade as a short, again, you could probably hold on this trade for a little bit longer, but once it got down to this true range, you would think about exiting that trade, or at least locking in profits somehow. All right. The other thing, again, we did is talk about targeting, looking for potential zones. So let's go back one other day. So again, this is an overnight low, pivot low, where price changed direction. This occurred in the overnight session for gold. It happened around midnight. It's the opening of the Asian market. Again, gold is a 24-hour market, but when I woke up in the morning, let's say 8 o'clock in the morning, it was my overnight low. Again, we're in a futures market. So I could add that measuring stick, and that could predict a potential price movement to the upside, but also allow me to start looking for trading opportunities. Now, the trend for gold for the last 3 or 4 days has been up, but the trend over the bigger picture has been down. So I might be looking for that contra trend price movement to look for an opportunity to re-engage the stronger trend, in this case, this downtrend. So the ATR is predicting this is where price should fail or start to come to the extreme of the true range. So I can look over to the left and look for a potential area of supply or an area of resistance. Now what I'll do here is, here's where I'm going to drop down to even a lower time frame. In this case, 15 minutes. And what we see here is a nice area of resistance. Now, why do I call this an area of resistance or a supply zone? Because it is a former level of support that now has become resistance. But the other thing that we just talked about is this pivot significant to us? And yes, it is. Why? Because it was created between 8 a.m. and 8:30. In other words, the opening of the US market. Now, notice that it is a reaction to this little peak here, which is the European open as well. So a very significant area of resistance, and that price returned based on our ATR right to that zone. So that would have been a good targeting for me in terms of looking for a short entry. Again, somewhere inside of our true range, but at the extreme of our true range for that particular day. And then notice what happened. We re-engaged that higher time frame downtrend, and price is now what? Fallen away. So this little uptrend found significant resistance based on former support resistance change in price action. Okay, so again, understanding the true range can help us make some predictions. Now, I'm just going to do this really quick. And again, you have to give me a little leeway that the average true range is always changing. But let's use this yardstick that was created based on the price performance of gold over the last few days before that. Now, notice what happens here. Here's a pivot high right there. Where did price go down to? Well, it went all the way down to here, right? Our true range. Here's a pivot low. This one was created around 9 o'clock in the morning, 8 o'clock in the morning, right here. This is where price started accelerating away. Where did price start to fail? 1 ATR. Look at the price movement here. Here's a pivot high. Where's the low? 1 ATR. Here's a breakout, right? An acceleration, a pivot down. Where's the low? 1 ATR. Here's a pivot high. Here's a pivot low, right? Where did that low come in? 1 ATR. Here's a pivot high. Where did market break down from, right? From that pivot low. So using the measuring stick of probability not only helps me define price action in terms of the playing field of probability, but it also allows me, once I get into some of these trending intraday trends, allows me to be a little bit more patient and look for a little bit greater target. As long as that trend, that intraday trend, is continuing to go in my favor, I can start looking for targets at the farther extremes of the average true range. Now, I could go in a lot more detail about this, but I need to move on a little bit. But under our archives and our webinars, if you go under the archive webinars and you see where it says search keywords, I want you to type in the keyword clock. And I have a previous webinar, which is called Timing Futures Market Opportunities with a Clock. And in this one, what we do is it's a lot more detailed of this concept of using pivots that are created at a very specific time of day, these openings and closes, and using our ATR to help us do price extrapolation or price predictability. So I recommend, if you want to get a little bit more information and detail about that, go and visit that archived webinar. Okay. All right. So let's do this. All right. Swing traders. We're going to look at ATR as both a breakout filter and as a stop loss filter. Now, the concepts are basically the same. It's just a reverse of entry versus exit, but there will be some minor adjustments. So let's look at the breakout filter first. All right, so in that one, we're going to look at adding a multiple of ATR. Now, my preference is 1.5 times, but you can make it 2 times, 3 times, whatever you want. Just realize that the greater the multiple also will make that breakout be much larger, which could also take away from some of your profitability. But we're going to add this filter to our breakout range to help us confirm a breakout price action. Now, since ATR rises and falls with volatility, a greater ATR will mean that we're going to need a lot more proof of price movement in order to confirm that breakout. Okay. So let's go to, here's a good example that I was looking at, is Microsoft. Again, I'm going to go to an interactive chart. I'm going to make the chart a little bit bigger. And let's drag this over to the left a little bit. Okay, here we go. Great. So what I've done here is a couple things to make this a little bit easier. First of all, I've added the study for the ATR in a new panel, the ATR of 14, and then that smoothing or detrending 20. And also I've added to this chart you can see up here, I've added the 20-day moving average and the 50-day moving average. 20 is represented in the blue line, and the 50 is represented in the black line. Okay, so what do we have here? So what we see is that we have prices kind of meandering around. Our 20-day is kind of floating back and forth. Our 50-day is trending higher. We're in this kind of this range as represented by this pink box where the upper end of the range is up here and the lower end of the range here. And I'm looking for a breakout opportunity. Now my 20-day moving average crosses over my 50. That is usually in an indication of a bullish signal. That's a positive price momentum. But I want to wait for a confirmation. In other words, I don't want to just get sucked in by a moving average crossover. I want to make sure that not only do I get a crossover, but the price breaks out of the range. Now you can notice on the crossover day, we still hadn't gotten out of the pink box. We didn't get that price breakout confirmation. Even the following day, we really weren't there. We're kind of knocking on the door. So what we're going to do is we're going to take the ATR, the daily ATR, and we're going to add a filter to our breakout range. And once price gets above that value, then that would be a confirmation that this is a true breakout and not a breakout potential fake out. So what do? Is I go back and look at my ATR, and you can see here that, again, the black is the 14, the blue is the 20 smooth. And you can see over here to the left, it's around 420, 418 for the black, 424 for the blue. So let's take this, split the difference, we'll say 420. So my ATR is 420. I'm going to add a breakout filter of 1.5 times that. That comes out to about $6.30. And then I'm going to add that $6.30 to my breakout high range, which is coming right here on this candle. Now, if you notice up here in the left-hand corner, it does say the high, and it says the high was 263.19. So I'm going to add that to that value, which means that I'm going to get a confirmation of 269.49. I drew a line here, 269.50. Okay, so as long as price gets above there, that would be a confirmation of our breakout. And there we go. There is where we got that confirmation. And price continued to move in that direction. So it's a really nice little way to really kind of make breakouts perform a little bit before we jump on that bandwagon. Now, if I do look at, again, this range, where we're getting that 20 crosses the 50, again, another technical buy signal, right? Again, I can do that process. This is what I did, and it came out to about $7. And so I added the $7 to this breakout high, both of these here. And that gave me this blue line here. And so I needed price to get above there to join this trend. Now, in this case, we had a gap and go. So this would have been a really great, you got multiple confirmations that this is really a nice strong trend in terms of price action. Not only did you get the breakout filter based on the ATR, but you got the gap and go technical aspect. Okay. All right. So the other part of the equation of using ATR as a filter is to use ATR as a stop loss filter. And in this case, we'll use maybe a little bit more. So 1.5 to 3. Now, Wells Wilder in his SAR, his stop reversal, he uses a range around 2.8 to 3.1, so almost 3 times the ATR for a stop filter. But we're going to add or subtract that above or below a trend line, depending on an uptrend or a downtrend or a moving average, and that we're going to require price to travel further before it stops us out or for exiting a trade. Now, this technique does increase the cost risk. In other words, price is going to move farther, and then I'm going to exit the trade. I'm going to lose more money. But it also helps lessen those whipsaw exits. A lot of you have probably experienced it. You'll set a stop near a trend line or a moving average, And that, a lot of traders do that. A lot of stops get clusters in that area. And there are traders and algorithms that hunt these stops out. So this is going to put us a little bit farther away from those clusters of stops. Okay, so here we have an uptrend. Again, we've kind of, price is kind of meandering. I'm getting a little bit concerned. And all of a sudden price breaks below my 50-day moving average. That might be an exit point. Certainly there would be a lot of stops that would be gathered just below the 50-day moving average. So what we said, we could use 1.5 to 2 times based on the ATR. Now, what I might do on this part of the risk management is I'll look at what 1.5 times the ATR is in a dollar value and how much that dollar value relates in terms of the price of the stock, or in terms of, do I want to risk that amount of money in terms of my profits. But in this case, we can see that our ATR on this particular day was running around, $8.12. Let's just say $8. And if I use 1.5 times $8, that's around $12. Again, do I want to risk $12 worth of loss to stay in the trade? Maybe I do, especially considering this is a $300 stock. Less than 5% of the stock. But notice that on that day, the 50-day moving average is 332, excuse me, 325. So $12 below that, $16 below that, 2 times it would put us down around, 312, 310, and that would be down here. I wouldn't have gotten stopped out. Now, notice again, price breaks below my 50-day moving average. Now, it's more significant to me here. Why? Because my 20-day is now getting closer to that 50. Again, when the moving averages cross over, that is usually an indication of price change, or a change in direction of trend, or in this case, a selling signal. And again, if I look at my moving average, my 50-day moving average, in this case, 332.72 up there in the right-hand corner, and my ATR on that particular day was 7.4. So what's that, about 11? 11 and a half. Well, 11 and a half from 32.70 puts us around 320. And that's where we would have stopped ourselves out. Now, I find it's kind of interesting that in this scenario where I've laid out for you, we put our stop very close to where there was a significant support level before. So again, you could manage this a little bit, but at this point, I think because we had the moving average crossover, another indicator, another enhancement, probably going to be true to the indicator, true to my game plan, true to my trade plan in this case. Now I'm 1.5, 2 times below my moving average. I'm going to get out of that trade. All right. Okay. Let's see how we're doing on time here. I do want to show you one cool thing on this one. Let's go back to this one here, and I forgot this. So we talked about that ATR is related to a lot of other technical analysis. And one of the technical analyses that are out there that uses ATR is something called Keltner bands. There they are, Keltner bands. And if I added this study to my chart, this one, it's like Bollinger Bands, but it uses ATR instead of standard deviation like Bollinger Bands. So this is using the 20-period ATR, and then it's using a multiple, again, that filter that we talked about. So if you didn't want to do the manual process that I went through, one of the cool things you can do is use Keltner Bands and use this. And here I'm using a 1.5 times filter. I think the default for us is 2.5 filters. But I could add that to my chart. And let's go back to that original one. Notice that once price gets above the filter, you can again use that as an indication that you're going to get that price breakout. Notice that the Keltner bands in this study did give us a breakout before the filter process that I showed you. So it does get you into trades a little bit earlier. And the risk management on this one would be if price broke back below the band, maybe back towards your mean, then that would probably be your risk stop out, okay? Or maybe say the previous candle, if it got below the previous candle, you could use that as a risk stop out. So this is kind of a way you can do that same process using one of the technical indicators that does use ATR. Okay, so let's move away from that. And I want to talk about the last one, which is for our positions traders, and this is really for stop loss management. We're going to look at longer period moving averages to help us manage risk. And one of the techniques is called the chandelier exit. And in this case, what we're going to do is we're going to look at a multiple of a 50-day ATR. Again, Wells Wilder kind of talked them in that 2.8, 3.1 range. I'm just giving you a suggested range of 2.5 to 4 times. And this can be subtracted from a recent high, maybe an all-time high, a monthly high, a weekly high. And I kind of use this one when I'm getting close to my target, or I'm feeling that the momentum of the market is changing, or that there's other external forces to the stock market and that I might be concerned about profit, especially after I'm a trade that has done very, very well. All right. So we're going to set a stop that's going to be placed from the recent high minus the ATR multiple, all right? And so for low volatility markets, we might use a smaller multiple. For higher volatility markets, we might use a higher multiple. Again, this stop loss placement technique is just purely based on that particular security's volatility. All right, so let's go to Apple. Actually, let's do this first. I just want to show you again under the technical analysis, right? We have our 50-day, that's where you could pull it from. But what I've done is I've created a template, and I'll show you what that template is at the end of our session today. It is in our slides. And I have a 50-day and 20-day, 50-day moving average, and I'm also going to use the 50 period ATR. Now, what I want to do here is, because the yellow is kind of hard to see, let's change that to make it black so we can see it. Okay, so we're looking at the 50-day ATR. All right, so again, one of the things we can do is after a long extended rally and I'm making an all-time high, or I'm making a very significant high, or maybe that's a 6-month high or month high, what I'm going to do is I'm going to take that high, and then from that high I'm going to subtract a multiple of that ATR. In this case, our 50-day moving average, 50-day ATR was around 3.55. So again, around 3. Let's use 3. So 3 times 5, 3 times 3.5 gives us around 11.5. So I've just kind of drawn a ray here and did a line based on the value. And what I'm going to do is once price breaks below 3 ATRs, I'm going to exit that trade. Now, in this case, it did fall below our 20-day moving average. Now, maybe I could have used the 20-day moving average filter. Again, maybe 1.5 times, probably would have come in very, very close to it. But here's a way for us to kind of manage longer term risk in terms of price movement. Now, notice that as, in this case, the ATR is getting greater. Again, I want to make sure that whatever multiple I use, am I comfortable with that in a price value? If I'm up here and my ATR is now at $4 or $5, or if I go farther in time, now I'm, and I'm using a 4 times multiple at $5, am I willing to give up, $20 worth of price on a stock that is, trading $170 or so? That might be too much for me. In other words, it's greater than 10% of that stock price. So again, you can use this as a risk management term based on how much risk you're willing to tolerate on that give back, and using the ATR to help you define that risk management. Okay. So I do see a couple of questions that Gene sent to me. Gene, any other questions you want to answer while I'm reading these couple ones that came up?
Well, go ahead and read your questions, John. I do want to point out that all of the charting tools that John has been using, including modifying the different studies, the ATR, and so on, this is available with a Barchart, a free subscription. If you just sign up with your email address, we create an account for you. All of your charts with the tools that you place in them are automatically saved for you for the next time you return to your chart. If you are interested, we also have a Barchart Premier subscription, which gives you a whole lot more as far as analysis, screening tools, option screeners, things like that. But specifically for today's session, the chart tools that John's talking about, they're available with a free subscription. I also want to point out that, like all of our webinars, this one is being recorded, and you will get a link in an email later on today to our webinar archive page. John's already showed that to you. It's in the tools section. It'll be under archived webinars. And today's session will show up there with a link to the recording. Okay, John, back to you.
Thanks, Gene. Okay, so I see a lot of our regulars in here throwing out some questions, and so let's see if I can answer them quickly here before we run out of time. So Aaron asks, when we're using a rising ATR, does that mean something to us in terms of a price asset movement? Again, Aaron, I want you to understand that a rising ATR is not an indication of a predictability of a trend. It's just telling you that the volatility is telling you that the range of price for that particular equity or security is going to increase. That's all it's telling us. It's just the range is getting bigger, okay? So Brian follows up with a question that is kind of related to this. And then Brian says, is ATR a useful tool in determining strike prices for options trades? Brian, yes, exactly. That's what we want to kind of do, especially as we're looking to set a trade. Not only can we start looking for that predictability about how far price could move on a day trade basis, but again, we could start using those multiples to set for instance, call spreads or put spreads, but also for timing inside of a day. Let's say you feel that the market is primed for a credit spread trade, whatever it is, right? But because you're going to kind of take a contra trend price movement. Here's where it'll allow you to wait in that day for a better timing to look for that extreme of that ATR, so that you get a little bit more credit. I hope that makes sense to you, Brian. I think it does, okay? So yeah, it can be used both ways. So a little bit better timing when you're looking to enter a trade on a specific day, but also using that multiple ATR aspect to set maybe the width of your spread. So great question there, Brian. So there's a question is, what if the ATR is already moved prior to my opening? And that does happen. And that is just kind of telling you, that's also a way of also telling you that you're having maybe what was sometimes referred to as an outside day. So what you can do on this one is, if you have an ATR movement in the overnight session and then you come into your regular trading session, use that, find those pivots that where price pauses accelerate, especially those that are being created in the overnight session that are related to, let's say, the European session, and then add or subtract the ATR from there, and that will give you kind of a new reset the ATR for that particular day. So you could have, in theory, a 2 ATR price movement day in a 24-hour period, and those would be like your 2 or 3 standard deviation days. So it does happen, and so that's kind of way you can kind of reset that. So John asked something about the relationship to ATR to pivots. So John, I didn't get a chance to do that and ran out of time, but yeah, what's really cool about that ATR extrapolations for day traders is go in there and set the ATR and then look under, let me see if I can do this real quick. Let's go back to gold. I'm going a little bit over here, folks, so be patient with me because I really think this is kind of cool. I didn't get a chance to do this. Yeah, so for gold, we set that prediction based on our ATR of down here today. Where is that around? Let's see. 180, 1844, 185 in that area. So what John's talking about is in our trader's cheat sheet, we do have pivots. And there you go, John, right there. Second pivot support, 184547. So yeah, they kind of lined up. So yeah, that kind of enhances that level, right? So great question, John. I wish I had a chance to talk about that. So listen, I don't have any more time. I want to get to our closing, and then so if I didn't answer your question, please just send them to support@barchart.com. They'll help answer the question. If the support team can't do it, they'll send them on to me, and I'll answer them. Just remember, this is a holiday weekend, so I might have to have a few beers before I get to answering those questions. All right, so a couple of takeaways. ATR, again, is a measurement of volatility, and it can be applied on a variety of purposes and indicators. There's a lot of other indicators out there that use ATR. I encourage you to try some of them out, but I gave you some ones that are not so common. ATR indicators, periods of low and high volatility. That's kind of the way Wells Wilder used it, very similar to like a Bollinger Band. But what I showed you in the Apple and the Microsoft example is an excellent way to use ATR in terms of risk management. And then finally, this measuring stick, this yardstick of probability, that the ATR indicator is a very precise tool that helps us find realistic levels of price action and help us find those buying and selling opportunities. And then again, to Aaron's point, again, it's not a predictor of price direction. It's just telling us how far price can go on a probability basis in that particular time frame that we're looking at, from day to day, opening to close, close to open, the next 15 minutes, whatever time frame that you want to use. Okay. So as Gene was saying, next week, join me. We're going to do a webinar on secrets to trading bear markets. We're going to look at some historical elements of bear markets, and then we'll also look at some techniques that are a little bit different from what we consider a bull market techniques. For instance, buy and holds, we have sell the rips, or excuse me, buy the dips, we have sell the rips, but also the volatility of bear markets is a little bit different. So we're going to take a little bit of a different angle. Again, if you're interested about being notified about some of our upcoming sessions, you can come in here and set up notifications. We're not going to spam you to death. We're just going to send you, hey, this is one of those webinars that's going to come up. Again, all of our webinars are recorded. You can get them through our tools archives, but we also have a YouTube channel, which all of these webinars end up on. So those of you who are watching YouTube are watching this on the YouTube channel, do me a favor in the comments, tell me what ways you use ATR. I'd be interested. I'm always fascinated in learning about other techniques that traders use. So if you like the session, again, if you're watching YouTube, give me a thumbs up. I really appreciate that. And in the comments, tell me what you guys are thinking of. Gene, anything else we want to talk about? I think that's
No,
it,
I
right?
think we're ready to wrap up for this long holiday weekend.
Yeah. Okay, well, Gene, thanks again for making the session great. I want to wish everybody stay safe out there this weekend. I want you guys all to come back next week. Be healthy and the good of all trading.